about 5 years as into being an attending, I had an accountant friend who was like, let me just look at your tax return. And, I was paying a pretty high tax rate. And he looks at my tax return and tells me, it's like, well, why aren't you an S corporation? I'm like, well, I've been told by a couple different people that it just really wasn't worth doing. He's like, well, it's going to save you like $7,000 or $8,000 a year in self-employment tax. He's like, what, you don't like money? Hey guys, this is Dr. Wright, founder of 1099 Tax Doctor. Today we're going to talk about things that your tax preparer may not be telling you about. If you're a 1099 physician or 1099 high earning professional, go over just a handful of things briefly in the next 6 or 7 minutes. So the first is with business expenses. People often refer to this as business deductions, but deductions are kind of a different thing in the tax code. Usually when people talk about business deductions, they're talking about business expenses. And a business expense is anything that is not prohibited in the tax law that is reasonable and necessary to run your business. So there are certain things the tax code says you cannot deduct. All right. You can't deduct your country club dues. You can't deduct dry cleaning of regular clothes that are not uniform. So there's certain things in the tax code that you just can't deduct. But, everything else kind of falls into the realm of if it's reasonable and necessary to run your business, then you can write it off as a business expense. And guess what? The IRS does not know your business anywhere as close to as well as you know your business. So if you think something is reasonable and necessary to run and operate your business, then you write it off. And that's what a good CPA should tell you. And a good CPA is going to look at your business books, look at your P&L, and say, well, you've written off a lot of expenses. This might, provoke a little bit of extra scrutiny, or wow, you don't have enough business expenses. Like most people have $20,000 or $30,000 of business expenses in your industry, and you've barely written off a couple thousand. So, are you sure you don't have some more business expenses? Go back and think about it. Go back over your credit card statement, see if you can find some things that you forgot about. But so, just the bottom line is, there's no like hidden business expenses or hidden deductions. People are always asking, what hidden deductions am I missing? Like, I wish I could tell you, but 10 minutes on the Google looking at articles from Forbes or whatever about business expenses is pretty much that's it, So that's business expenses is really when you're a high earning 1099 professional is really not where most of your tax savings comes from. These next things are significantly more important than business write-offs. So the first is not more important, but it's just a component is whether or not to be an S corporation. And, again, I've talked about this before, but an S corporation is not an entity. It's a tax designation. So you can't just have an S corp. You can have an LLC that is taxed as an S-Corp. You can have a C-Corp that is taxed as an S-Corp. But the reason you have an S-Corp is because it allows you to classify a portion of your earnings as a distribution, and that's not subject to payroll tax, Medicare and Social Security. And so, it saves you a little bit of self-employment or payroll tax money. For the first 5 years that I was out of residency, I was a high-earning 1099 ER physician, picking up extra shifts. I was young and hungry and working a lot and making pretty good money, but also paying a lot in taxes. And I went through a couple different tax preparers, and they never made any kind of suggestions about anything to lower my tax bill. They just cranked out the tax return. And that's because the business model of most accounting firms and tax preparation firms is simply just to crank out as many easy 1040s, personal tax returns, as possible. So you'll actually have people that will tell you, don't be an S corporation. It's not going to save you a lot of money. It's just not worth doing. And so, about 5 years as into being an attending, I had an accountant friend who was like, let me just look at your tax return. And, I was paying a pretty high tax rate. And he looks at my tax return and tells me, it's like, well, why aren't you an S corporation? I'm like, well, I've been told by a couple different people that it just really wasn't worth doing. He's like, well, it's going to save you like $7,000 or $8,000 a year in self-employment tax. He's like, what, you don't like money? I was like, well, no, actually, I do like money. I mean, you have to pay somebody to file the 1120S, which is the corporate tax return for the S-Corp. And you got to pay, a payroll company or somebody to handle the payroll component for it. Those services are still tax deductible. In worst case scenario, as a high earning physician, you're saving about $5,000 per year. It's not any more work for you. It's more work for your accountant. And it saves you $5,000 per year. So, why wouldn't you do that? Again, you don't like money. The main reason a lot of people don't like the S-Corps, a lot of accountants will kind of caution you away from it, is, again, it's not their business model. A lot of accountants and even CPAs don't have a ton of familiarity with corporate tax returns and the nuances of corporate tax law and S-Corp tax law. So they just kind of shy their clients away from it. It's just too much work for me, is what the accountant is sometimes thinking. I don't want to file this 1120S. It's only going to save the client $5,000 a year. I'm not going to make that much more money. It's going to take my time away from much more lucrative tax work, just cranking out personal tax returns. So that's why in the accounting world, a lot of people will kind of shuffle you away from the S-Corp. But for, physicians, 1099 physicians earning multiple six figures, it's going to save you $5,000 to $10,000 per year of self-employment tax. Why not do that? A couple other benefits to the S-Corp. It's the least audited entity. So if you're aggressive and you have a lot of business expenses, or you're aggressive with, business expenses, they look better on an 1120S corporate tax return than on a Schedule C on your 1040 as a sole proprietor. One other benefit of the S-Corp is the PTET workaround. So if you'll remember, back in 2017, Congress put a $10,000 cap on property tax deductions and sales tax deductions, state income tax deductions. So if you're a wealthier taxpayer in a blue state with a large house that paid a lot of property tax and state income tax, you could essentially write that off in your federal tax return, and then Congress capped that at $10,000. And the PTET workaround lets you pay your state income tax, and it works in most states. Most states will let you pay your state income tax as through your S-Corp as a business tax payment. And if it's a business tax payment, guess what? It becomes a federal tax write-off. However, you can't do that if you're just a single member sole proprietor. Partnerships can usually do it, and a single member S-Corp can do it, but a single member sole proprietor typically can't in most states. And so there's one extra benefit to the S-Corp. So, all right, that's enough on the S-Corp. It's, again, not the major vehicle of tax savings. When you're a high-earning 1099 professional, your major tax savings comes in the form of tax-deferred retirement accounts, be it a 401k. This year is right around a $71,000 limit. You can put into a 401k, a defined benefit cash balance plan, which has limits as high as up to $400,000. For most high-earning physicians, you can get $150,000+ into a cash balance plan, along with a solo 401k. And remember, that money is tax deferred, and it lowers your taxable income from the top of your tax bracket. So, if you're doing pretty well, making $600, $700 per year, you're in the very highest, tax bracket at 40+%. So if you put $100K into a cash balance plan, it generates $30,000 to $40,000 of savings on your income taxes. So again, it shuffles money from your tax burden into a retirement account that's not subject to capital gains tax and gets invested. And then you can leverage those retirement contributions to lower your taxable income to get the 199A or QBI deduction. That's the 20% small business deduction. But for physicians and other service professionals, it phases out. This year, if you're making more than $440,000 of taxable income married, that phases out. So you want to get that below $340,000 to capture the whole thing. And you can do that using a cash balance plan, maxing out a 401k, getting that taxable income down. So it's important someone who's comfortable, an accountant that's very comfortable calculating that 199A, that QBI business deduction, and kind of helping you know how much to put towards retirement in order to capture that full deduction if you fall into that income range where that's important. So those are kind of the common things I see that a lot of people don't realize as a 1099 that they should be doing. Fairly aggressive with business write-offs, anything that you're entitled to under the tax law, take it. Setting up an S-Corp, leveraging a good tax-deferred retirement account to lower your taxable income to get that 199A, that QBI deduction. These are all very fundamental tax concepts for a high-earning 1099. And if you're working with a inexperienced tax preparer who's just focused on cranking out your tax return every year, they may not be advising you about any of those options. So I just want everybody to be aware of what's out there. And thanks for listening. We'll see you next time.
You've been listening to the 1099 Tax Doctor podcast. Dr. Eric Wright isn't just talking about 1099 income, he lives it. As a physician and independent contractor, he's learned how to make the tax system work for him and for his colleagues. Learn more about how Dr. Eric Wright helps physicians keep more of their hard-earned income by visiting 1099taxdoctor.com. This podcast is educational only and not personalized tax, legal, or financial advice. We're here to talk strategy, not write prescriptions. Always consult your own licensed professional before making decisions about your own financial situation.